Okay, well, I'm getting a lot of feedback from the audience, so thank you. I love doing a webinar with John, and the bonus is Darrell, who brings me back to my disco days and Barry White, because Darrell is like channeling Barry White with that great voice. So thank you for the introduction, Darrell. For everybody in the Chaikin community, John Carter has been a friend and a partner for over 2 years. He's the best pure trader I've ever met, and don't take my word for it. A lot of my good friends down in Texas are in the trading room every day, and they tell me, Mark, if you stay in that trading room, you're going to make a lot of money. So this event is to share with you what John Carter and I are going to be doing at the conference in Austin in late March. On Sunday night, John and I are going to do a one-on-one, and we've got slightly different perspectives on the market, not totally in conflict, but a little bit different. And we're going to share some of that with you on the webinar this evening. John is, as I said, a great trader, and he's also embraced the whole Chaikin approach that a combination of fundamentals and technicals is what helps you make really big profits as a trader by giving you that directional edge. So with that, I'm going to turn it back to John. I'll be on with some examples, but John, why don't you take it away from here?
All right, so let me reshare here, and we will get going. So first of all, Mark, thank you for the introduction. And yeah, it's always great. It's actually very, very difficult to find good just partners in the kind of investing and education space for a variety of reasons. And what I love and working about with Mark is, first of all, he's been doing this for a long time, so he's seen a lot of stuff. And then the product that he put together not only saves a lot of time, but it just it kind of presents the best the best way to go on a platter. So it's a really, really amazing piece of software, and it's helped my trading in terms of incorporating some of the technical work that I do, and then just kind of doing a process check against the software, which I'll show you here shortly. And then from there, what we'll do is then, I'll probably talk for maybe about 15 or 20 minutes. And then Mark's going to come on. He's going to show you guys some setups as well. And then after that, I'm going to come back on and then explain to you guys what we're doing in Austin, which I think will be a really fun event for those of you that are interested. So, so my premise here tonight is, what is the next big move? And I love this image because for a lot of traders, if they don't really have a plan, they're not focused. It's always, what's, is it Bitcoin? Is it this? Is it this stock? Is it Tesla? As opposed to just kind of having a, kind of a checklist or a grouping of things that they're waiting for to happen. Okay, and I think that's really kind of good to know. And so the two things I really want to cover tonight are 5 stock picks that I like. And then at the same time, also do a little bit of what I see coming down the pipeline in the bigger picture. I mean, this is where too, I love comparing like the stuff that I'll see, say with Mark's outlook. And we may have some things that slightly differ, which is great though, but there's just more kind of like, okay, based on experience, here's what we're looking at. And at the end of the day, there's really a couple different things to kind of view from a market perspective. And one is kind of what I call macro. So the macro is what to expect in the years ahead, okay? And that's obviously going to not really matter if if you want to buy Netflix tomorrow and hold it for a week. But then from there, drilling down to timing, whether that's timing a trade for a couple of weeks or a couple of months. And that's kind of like the two pictures that I like. The macro is something that I like to keep in mind, but it does not necessarily drive my decisions. Okay, I'm more, yeah, gosh, the market should, the market should be doing this, but it's not, right? I'm always trying to follow what price is actually doing with an eye towards what could happen next, if that makes sense. So, so the thing I want to look at here real quick is that, I mean, I think we can all agree that tech right now is super strong. Tech and semis that's where the money flow is. That is what is leading this market. No question about it, no doubt about it. Also, the economy is strong, okay? And so the bigger picture things that I see right now, if there's any caution, it's if I'm looking at this right here, and this is a recent chart from today's close, is that, again, tech, semis, they're super strong. The NASDAQ is making new all-time highs this week, all right? So that's obviously fabulous. Now, if I drop down to the transportation sector, I always look at the transportation sector as kind of a leading indicator. I can see here that it actually started heading down a couple of weeks before the rest of the market followed, right? And that's fairly typical. And so right now I'm kind of watching this, and this is just your basic Fibonacci retracement from this high to low. We've come back up to the 618, and to me that's kind of the make or break level. And again, this is a purely technical. If we break through this and through there, and then we're off and running to new highs. But this is kind of that moment in time where we've done what I would call a normal retracement, but this is kind of the red flag zone where if this fails, then that could lead to another decline. And when I say another decline, it doesn't mean it's the end of the world or anything like that. It's just that, do we explode higher from here, or are we going to see, are we going to see a couple more weeks of weakness, right? Spiders, kind of the same thing. The spiders, we've been at this level now for 3 weeks. This is that 786 retracement. This is bullish, the action here off of this. But again, if we can't get through this and we end up closing the week back in here, from a technical perspective, it's like, wow, there's some distribution going on here, potentially weaker prices. XLP, consumer stocks have been just kind of in the doghouse. Now utilities, utilities are different. Utilities have been falling since December. They're a different kind of leading indicator, and I'll talk a little bit more about that, but it's not so much the markets that it's reflecting, but interest rates, okay? We just want to keep that in mind as well. And so real quick, for the economy, fundamentally, consumer confidence is obviously super strong. Consumers are spending, jobs are being created, manufacturing is very strong, jobless claims are at a 45-year low, and wages are up, i.e., it doesn't get much better than where we are right now. Unemployment has dropped to 4%. Now, the leading index of LEI, leading economic indicators, keeps hitting new highs. This is actually a little dated, but we're actually up in here right now. This is the same with economies around the world. I think there's only maybe 3 right now that aren't growing, and they're like Venezuela, Saudi Arabia, and I think like one more, but all the other ones are doing, they're doing great. So typically this indicator will top out and start declining like a year or so prior to a recession hitting. So the main point with this is that there's no, according to this, there is no danger of a recession on the horizon in the near term, okay? Also, so far so good on the yield curve, okay? Yield curve is when short-term rates are suddenly higher than long-term rates, okay? And when that happens, typically you're looking at, like looking at the 2-year and the 10-year, that also takes place before a recession, okay? Or before a market, so we can see here, boom, 2000, boom, 2008, boom. So again, that's not happening now either. So there's a lot of talk right now. It's like, oh my gosh, the markets are frothy and stuff like that too. And sure, that's a good argument, but there's no signs of danger signs of the economy, losing steam. For real estate, new home sales are soaring, so no concerns on that front either. The one thing here that's interesting is we call it the Fed credibility gap, and you can see this gap here. There was no credibility gap here. Now, also keep in mind, kind of, where, even though the home market is heating up, we're actually nowhere near the highs that we saw like in 04, 05. What the credibility gap is that when the Fed talks hawkish, but retreats from raising rates at the slightest sign of turbulence, okay? What I anticipate, for reasons we'll see, is that this credibility gap is going to start to shrink, meaning that, okay, when the Fed talks hawkish, they actually mean what they say. So what are some concerns about this? So the main thing right here is it's really about interest rates and inflation. And again, there's no signs that there's anything that's huge right now, but what we want to keep in mind is bigger picture, what could happen in this kind of situation. In the short term, it's actually a good sign. It's like, wow, the economy is really recovering. It's recovering so much that interest rates are starting to rise, okay? So stronger jobs, jumps in interest rates are all signs that inflation is getting triggered, okay? Again, in the short term, that's good. It means the economy is super strong. The problem is what happens if, if it starts pushing interest rates up even faster? Okay, eventually, okay, that gets bad for stocks. I would argue that it's not a concern until long-term rates get over 6%. Okay, but just again, keeping in mind a couple of implications of this. Now, this creates a fully ironic situation in the markets, which we're going to dive into a little deeper. In addition, there are red flags, I would say, in utilities and transports. The utilities especially have been rolling over, and it has acted as a leading indicator in the past. Keep in mind, this is not a sign of the economy slowing, but a sign that the market is accepting that more aggressive rate hikes are here to stay. Okay, we just want to keep in mind the potential implications of that. So the most important market in the world right now is interest rates. It is very likely that a multi-decade-long reversal is taking place in interest rates, something that hasn't happened since 1981. Okay, that was the last time that we actually had a turn in interest rates, that time obviously from a peak. At that time, the 30-year mortgage or the 30-year rates were around 15%. Since that time, literally for 3+ decades, we've been trending lower. That's the thing about trends in the bond market is they don't last, they last decades. So this means that a huge bear market in bonds could just be getting started. I think it is. As interest rates rise, bond prices fall, and this move could be exacerbated by any signs of inflation. So the fact that rates are kind of going up, obviously that's going to push bond prices down. But if the bond market senses that that inflation is going to start increasing at a more rapid rate, bonds will actually start selling off even more. Okay. So this is just a quick, 1,000-year picture of interest rates and the cycles that they go through. You can't put too much, that's a little esoteric there, but you can see as we get closer here, I mean, essentially, so we have a lot of times what rise in interest rates, what happens? Well, you can see, okay, War of 1812, peace. Civil War, rise in rates, peace. World War I, peace. And then from here, 1941, or as we broke into, they hit the Great Depression, where the interest rates we have right now are actually got lower than the Great Depression. That bumped up industry and started the next, essentially 30+ years of inflation. And now here we are. And so the question is, we're at a point here where it would make sense, based on these multi-decade cycles that we've seen, for us to start turning higher. Okay, and what are the implications of all that? So if we look at a monthly chart of the bond market, you can see that there is a massive head and shoulders top in place. This is something that could resolve itself in a big way to the downside. Now, the nice thing about this from a trading perspective is that there's an instrument, TLT, which is fairly liquid, and we can buy long-term puts on this to benefit from that move. Okay, so again, from a trading perspective, I would say, like, whatever the economic landscape is, it doesn't really matter. From a trading perspective, there are instruments that we can utilize to take advantage of it. We just want to understand what's potentially coming down the pipeline. So from a macro trade and a technical trade, I actually really like short bonds, which we could play via TLT. Keep in mind, these are forecasts of mortgage rates. So mortgage rates have been ticking up. The good old days of 3.66% rates are over. Right now, to me, 4.22%, 4.5% is still pretty good. We're looking at in 2020 getting back to 6%. So from a practical perspective, we want to keep in mind that if mortgage rates go up, that's going to take money directly out of the consumer's pocket. Money that's out of the consumer's pocket is not money that goes into the rest of the economy. If you've been thinking of locking in your rates, I would do it tomorrow. Okay, this is a trend we're looking to kind of keep going. Here's the one that the one stat that I think is scary, and I don't know, how completely accurate this is in terms of, a lot of it depends on when some of these notes mature. Here's the short version. So again, this is all not exact figures. This is all top of mind. So back in, a lot of, like, say 2000, right? We had $4 trillion in debt as a government. And our expense, our annual expense was about $385 billion, okay? Now, we ballooned that to about $24 trillion, But because rates nosedived, guess what? Our payment stayed about $385 billion. All right. So from a payment perspective, nothing happened. There's just a lot more debt, but the payments haven't changed. Awesome. So the idea here is that if interest rates really start ticking up, what happens when that $385 billion payment, comes up to $1 trillion, okay, or $2 trillion a year in interest? Well, they've got to get that money from somewhere. And I think the implications there that we want to think about is, where is that going to come from, right? Taxes and stuff like that too. So that to me is probably the biggest potential drag or scary thing off in the distant future. And I bring that up now because there are, the ways to, first of all, profit from that, but secondly, protect ourselves. Like, okay, getting into really researching tax deferred vehicles. If you're doing real estate, make sure you're doing 1031 exchanges. Anything tax deferred like that would help quite a bit. Bonds and dollars. China, a huge buyer of U.S. bonds over the years, is saying it will start to slow down purchases or even stop them due to trade war tensions. Okay, again, more downward pressure on bonds, which results in a rise in rates. And then the other thing here too to keep in mind is the dollar. So it's a rise in rates and a strong dollar go hand in hand. But what's interesting right now is that everybody on the planet, everybody in the world, from an economic perspective, wants the dollar to stay about where it is or lower. The U.S. would like it lower. When the dollar, and we'll get to a chart of that, but the whole idea here is it's about trade deficits and things like that too. But so here's a monthly chart of the dollar. Keep in mind this was the peak out in 2000, okay, and then the low level that we hit in 2008. Since then, from a technical perspective, retraced to 618. And so the question now is, are we going to be able to break this? There's definitely an aggressive policies in place right now for a weaker dollar, and they're just going to have to combat higher rates. So I'm just fascinated to see how they do it. When the dollar was up here, this actually hurt the global economy. It slowed down U.S. global trade, okay, which slows the global economy. But more importantly, it killed the emerging economies. All their debt is dollar denominated, so this is like an adjustable rate mortgage for them. So it's going to be an interesting battle to try to keep the dollar low while battling rising rates. Okay, and the two really can't go hand in hand. So that's what we got. So again, and that's keeping in mind what happens in that situation is that when you have rising rates, you have increased cost of borrowing, which reduces the amount of investment, which lowers economic growth. You have higher mortgage interest payments, which reduces consumption, which leads to lower economic growth. Increased return of savings because, hey, you're getting a return. Also reduced consumption, you get falling housing prices, et cetera, et cetera. So just, again, we just want to think of the long-term stuff there. And the main thing here that I am keeping an eye on is that the government will see a rising borrowing costs because that can actually impact a lot of policy. All right, so not to spend too much time on this, but just some things to keep in mind. So industries that do well in that environment, financials, okay, JP Morgan, TD Ameritrade, financials will love this, and they're already showing signs of that. Consumer discretionary stocks, because keep in mind when interest rates are first kind of rising, that's an indication that the economy is super strong. So kitchen appliances, cars, clothes, hotels, restaurant, movies, all that kind of stuff, all its kind of benefits. And then last, small caps. Okay, small cap companies typically engage in domestic business. They're not involved in international. And since rising rates in the U.S. economy, you have small cap companies that are just working in our economy. Boom. From there, buying puts on TLT. Okay, that's TLT is a reflection of a mix of bonds, but it'll fall with interest rates rising. And then I'd really look at tax deferred vehicles from Roths to 1031 exchanges and getting them set up now. Because if there is going to be a huge increase in taxes down the line to pay for all those higher interest rate, those debt payments, we want to shield what we can from that for as long as possible. All right. So that's kind of the thing there. Real estate and industries that do poorly. Shorting utilities and telecoms. Okay. We've already seen this in utilities. They are essentially bond substitutes, so they go down with the ship. Not all REITs, but a lot of REITs are also yield plays that'll go down with bonds. Again, another shorting opportunity. And then global industry and energy companies. These stocks that have high yields right now that are due to depressed stock prices, not increased cash flow. Rising rates are going to hurt that cash flow even more. Okay. So as we're looking at that, there's a couple of stocks here that I like. So from a weekly perspective, okay, I want to show you some stocks real quick. And one of them that I like here is Baidu. And what I've found on this stuff is that before I might see a stock like that I like, let's say Grub, okay? And you'll see here that it's like, okay, that looks interesting, right? And then, or maybe Facebook. It's like, okay, Facebook, that's got a squeeze. Well, I'll show you something that helps me with Mark software. So one of the main things I look at here on these weekly charts is like, okay, do we have a squeeze? And for those of you that don't know what a squeeze is, that's essentially, it's a signal about a compression in volatility, okay? So here's a compression of volatility, and then when that volatility is released, okay? Here's a compression of volatility, and that volatility is released. And sometimes moves can be fairly substantial when that happens. What I've found personally is that if I can match, like say, a squeeze with the software here and say, okay, well, let me take a look at Facebook and just say, all right, what does this look like here? And I'll say, okay, well, Facebook, all right, so you can see like some of the kind of the package here, I'd call it neutral, and we can see it looks okay, right? But we can see relative strength versus the spiders is kind of low. So there's a few things like that that, you know, will stand out. So what I like to do is when I see something that I like, all right, so like VeriSign, is I can bring that up and say, okay, well, I like the fact that there is a weekly squeeze there. Okay, and again, that's kind of a technical thing that I like to look for. But then when I find it, I want to, you know, kind of double check it with Mark software and say, okay, well, great, we've got, you know, we've got some good relative strength there. We got the power gauge kind of cruising here, overall bullish reading there. And so that helps me match kind of technicals and fundamentals. And so that's one of the things I like to do with this. And I think one of the reasons like our, you know, it gels so well is that a lot of the technicals that I'll look at will tell an attractive technical story, but I want to make sure that that matches up with, you know, kind of the fundamental story and all the other additional elements, you know, that Mark will bring in. Another one I was looking at here is Yelp, which was also one that had come up, and then ICLR, and this is Icon. And you can see on this, it's like, okay, wow, here's a squeeze setting up, all right? And we can see the reflection here of like, all right, here is a squeeze that's set up here. And, you know, again, it's kind of like these short-term power burst moves, which I really like to do with options. And you might think, well, gosh, that's kind of a short-term trade. But keep in mind, this lasted, you know, 2 months. And before, if I'm looking at doing something like that right now, you know, I could come over here and just say, okay, well, is this, you know, I want to make sure that this kind of fits in with everything here, and I can just double check and see. So anyway, that's again, just wanted to kind of go over a few things there. And Mark, let me hand this over to you because I liked what you were showing in your presentation as well. And then from there, what I will do is then come back and I'll tell you guys a little bit about Mark, what Mark and I are going to be doing together in Austin.
John, thank you. And I've got to tell you, folks, I just came back from San Diego, what is probably the best macro conference in America. You had people like George Gilder, the futurist, 80 years old, Jeff Gundlach, the largest bond manager in America, David Rosenberg, Gluskin Sheff, quoted in the papers today saying, bull market's over. Basically, the theme of that whole conference, and it runs so counter to what John just gave you in the macro view, was we're all going to die. I just can't tell you when. John just gave you a macro view that you can use. This conference, where we participated with a good partner who John knows, was all about the negatives. And John Carter just gave you a macro view that you can actually utilize and make money because he's not giving up on the markets. He's telling you where the opportunities are. I love the bond trade. We're actually looking at a short-term TLT vertical put spread here with about 6 weeks to go. But let me just give you a couple of comments on John's observations before I go into a very short presentation here. Yield curve. John showed you the yield curve. What nobody talks about is if the yield curve makes a 52-week low and doesn't invert or go negative, that is the most bullish thing for the stock market 3 to 6 months out. We had that in June of 17. We had it in December. So keep that in mind. Most people cherry pick the yield curve and they predict where it's going to go. Don't predict. There's an old saying on Wall Street, on the floor of the stock exchange. There are very few traders left there, as we all know. Make money, not predictions. So yield curve makes a new 52-week low and doesn't invert or go below zero. That is the most bullish thing for the stock market. Second thing is John talked about 6% level on long-term bonds. JP Morgan Asset Management came out with a study 3 weeks ago that said the real inflection point is on the 10-year, which is not long-term. That question came up, 5%. Now, we started out at zero, which we've never done before. So I'm looking at 3.5%. But John's right on. Long bonds, 30-year, 6%. We've had a 5-year, 6-year bull market in bonds. The worst place for your money right now, in my opinion. Therefore, you have two choices. You either go to cash, which actually is yielding pretty nicely now, or you go to stocks. So where have we been on the stock radar screen? We've gone from an uptrend on autopilot in 2017, where we didn't have a correction of even 3%, to a roller coaster of a pullback that turned into a correction. And the primary reason it turned into a correction is A, it started with one data point about inflation. In January, the hourly wage at 2.9% annualized. That all got taken off the table just last Friday when it turned out that one data point was an outlier, but it turned into a correction. Why did it turn into a correction? Some esoteric exchange traded note based on low vol that the hedge funds and the CTAs were using blew up. So we got a 12% pullback. Is that the end of the world? No. Why? Because the market's stabilized. Now, we did run into a top on the first rally, which I think was a 618 retracement, John. Correct me if I'm wrong. And part of the reason that that rally ran into resistance, Chaikin money flow, which John talked about. It should have gone positive on that huge rally from 25.33 all the way up to 27, I think 70. It didn't. What did that tell you? The institutions weren't really participating in the rally. So we pulled back, and now we've gone up and we've made a higher high. This is a really bullish pattern here, short term. Higher highs and higher lows. Now, would we like to see the market take out 28.73, which was the high on the S&P? Absolutely. Want to see the transports go up. But all things being equal, this market has stabilized. The liquidation from these odd ETN trades that had to be unwound. Lots of margin calls on February 6th. Got to realize that margin calls still exist. So it's an anachronism that goes back to the 70s. So stock market's still in an uptrend. We didn't break that downtrend. This is from the May lows, but go all the way back to the beginning of this bull market. Uptrend is still intact. So what do I think you should focus on? Well, it's some of the same stuff John was talking about. Trend of corporate earnings, really positive. We ended the 2017 first quarter earnings season, just ended a week ago. Very positive. Company guidance for 2018 is wildly positive. Now, part of that's a tax increase, but FactSet is projecting a 16.8% increase in corporate earnings in 18, 7% in 19. So part of that's a tax increase, but company guidance is 25% positive in the S&P. We've never seen a number like that. Interest rates, John did a great job. Interest rates are going up, but if the economy is going up and interest rates are going up slowly, that's very bullish. Why? Because interest rates are going up because of a rising economy. Sector and group strength and weakness, John touched on that. Utilities, real estate, consumer staples, very weak. Going to show you what normally goes up in a rising interest rate environment, and then ultimately stock selection. And there's where John and Mark come in. John does this extraordinary technical work on individual stocks with the squeeze and the ready aim fire, which I absolutely love. So let me show you a few examples of this. Let's start with the bonds. I'm going to use a 5-year chart of the TLT, which John has already featured. All the headlines would have had you running for the hills in the stock market because bond rates were going up, yields were going up way too fast. Well, if you looked at a 1-year chart, there was a breakdown. But let's look at a 5-year chart. There's nothing unusual going on here. We've been here before. We're not even at the yields, because this is the inverse of yields, that where we were in 2015. So bonds are doing just what they should be doing, as John pointed out. Strong economy, jobs being created, earnings going up, more importantly, top line revenues going up. You should expect bonds to be going up. Welcome it, but don't be in bonds. If you're out beyond a 2-year maturity, you're putting your capital at risk. So here's the scenario for 2018. This is courtesy of Bank of America Merrill Lynch. We're in a very bullish environment, which is rising earnings and higher interest rates. And interest rates are going up for the right reason, and we still don't have inflation. So I think the most important message I can give you on this webinar is ignore the headlines. Because if you were listening to the headlines or some of the experts, and they're really smart people, I'm talking Jeff Gundlach, David Rosenberg, people, Lacey Hunt from Dallas, John probably knows him, used to know him in Philadelphia. They're all telling you valuations are off the charts in the 97th percentile. That is bullshit. Sorry to be sort of flowery with the language. With inflation between 1.5% to 2%, where do you think PE ratios should be? 18.6%. It's exactly where we are. So people will cherry pick numbers to support their conclusions. Don't buy into it. With interest rates where they are and inflation where it is, PE ratios are just fine. So people who tell you that PE ratios are extended and therefore we're going to have a bear market, nonsense. Valuations have never caused a bear market. Recessions cause a bear market. John's covered all that. We do that in our weekly market letter. So here are the sectors that do well in a rising interest rate environment: financials, industrials, technology, energy, and materials. The only outlier right now is energy, which is in its own sort of world. These are what's known as cyclical stocks. I used to think cyclical was like a curse word when I started out in the market. I want growth, not cyclical. Well, it turns out growth and cyclical are the same thing. I've just learned that recently after 52 years in the market. Cyclical stocks go up in a rising economy. What does poorly is what John pointed out: utilities, telecom, consumer staples, now real estate, which is now spun off out of financials. And healthcare is now sort of a tweener. And consumer discretionary has always been a tweener. Now, you got to realize if you're trading select spider sector ETFs, as John often does in his trading room, XLY, consumer discretionary, 20% Amazon. So there's retail in there, there are cruise lines, there are home builders. It's a very diverse sector. Almost better to trade industry groups within that sector, like home builders, where there's huge pent-up demand for millennials. But here are the industry groups that do well and poorly in a period of rising interest rates. You can use this to your advantage by shorting stocks in real estate. Utilities may be overdone, and we're in a seasonal period where utilities actually go up, not down, but consumer staples and real estate, you bet. We're on the short side. Industrials, financials, technology, very overextended, but when I show you the chart on Micron, you'll see that overextended is not always your enemy. So my basic belief that's going to drive the conversation that John and I are going to have in Austin on March 25th, and I think this is the most exciting event anybody could possibly participate in, is that fundamentals drive the market, but emotions drive the market to extremes. So your path to profits is a combination of fundamentals and technicals. That's as John articulated, why this wonderful partnership and friendship is blossoming, because we give you a quick fix on the fundamentals for 5,000 US equities, little bit of technicals thrown in, mainly relative strength and money flow. And John has these incredible signals. Ready, aim, fire is my favorite thing in the world, and these compression signals are great. So John has already pointed out that the power gauge, which is our go-to fundamental indicator, is an awesome meter for stock. Thank you for that, John. We've overused this, but everybody loves you, and this is a great quote. So what's in the Chaikin power gauge rating? Because that's what John's looking at when he's looking at stocks like Baidu and VeriSign. 20 factors. The reason the model has worked for 7 years is that this is what successful buy-side portfolio managers of Fidelity, T. Rowe Price, Invesco, the big hedge funds are looking at every day. They don't all look at each of these factors, but this model is what I call reality-based. It works because it's based on how Wall Street works. So this model's been out there for 7 years. And the validation that I love the best is there are now 2 exchange traded funds, and I'm not going to tell you the symbols because I'm not registered, so I can't recommend them. Large cap and small cap introduced by New York Life, $800 million in less than a year, being managed with the power gauge rating. It's not managed, actually, it's buy and hold. Power gauge rating is the ultimate decider. This is sort of George Bush for ETFs. Power gauge decides what gets into these ETFs, and they stay in place for a year, and they're all outperforming their benchmarks. So a couple of examples. We saw what should happen in a period of rising rates. We use the power gauge on the individual constituents in each of the 10 select spider sector ETFs. This tells you the potential of these sectors to outperform the market based on looking under the hood. So what do we see? Just what we should see. Financials, technology, and industrial with the best difference between bullish and bearish ratings. And at the bottom, consumer staples, real estate, and utilities. So reality and past history are meshing. So how do you make money in this environment? Because I'm a firm believer that the trend is your friend. John is as well, both short and intermediate and long term. Right now, the trend is up. Yes, we will have a bear market. In fact, we're coming out with a service later in the spring that addresses that. So I'm 100% on board with where John is. What I look for are stocks with a bullish fundamental rating. That's the Chaikin Power Gauge, outperforming the market. So that's VeriSign, Baidu, um, Yelp, with strong Chaikin money flow, telling you the institutions are buying. So here's an example of that recently. AbbVie is a cross between biotech and a drug stock spun out of Abbott Labs. Now, you got to have conviction to make money in the market. That's why the people who are in the simpler trading room make money, because they develop conviction listening to John and Henry, who uses the Chaikin Power Gauge rating. But here's AbbVie. Everything was bullish. At the bottom of this 1-year chart is the power gauge. It's been outperforming the market with institutional buying. You get an oversold buy signal. How many of you would pull the trigger on February 6th when you see AbbVie down 8 points from 110 to 102? Not that easy to do. My wife Sandy did it. Why? Because she believes, and she's willing to pull the trigger on stuff that's worked over and over again. So you've got to look for quality stocks in this environment where everything is lined up. So AbbVie is a great example. Now here's a recent stock that I made my bullish stock of the week. It used to be called AmSurg, or American Surgical Mobile Surgical Centers. They did a merger. This is a rumor takeover candidate. There's going to be a lot of M&A activity because of repatriation of dollars from overseas based on the new tax bill and more cash. Companies are paying lower tax rates. So this stock's been in a pretty long-term downtrend, but it's now in either LBO or buyout candidate. How do I know that? The analyst at JP Morgan is telling me, and other brokerage firms. So power gauge has just turned bullish, and relative strength has just turned bullish. I love this stock. I want to buy it on a pullback. If I could get a ready aim fire signal, I would just load up the boat. Now, on the downside, power gauge rating bearish, underperforming the market, institutions selling. Here's the confluence of what John told you and what we do. Weak sector, real estate. Why? Interest rates are going up. Also, the mall REITs are affected by the weak retail bricks and mortar business. But this is Avalon Bay, that is the largest purveyor of rental properties in America. Now, here's a stock that's making new 52-week lows as the market was making new 52-week highs. You've just had a rally in the stock. What a great opportunity to put on a put trade, bearish put spread, or go short the stock. Typical top-down approach. Interest rates are going up. What's affected? Real estate. Look for weak stocks. And now you put on some trades that can really work out. Talk about tech. There's Micron. Here's my favorite spot to buy it. When the stock has just broken out of a base, that's what John was looking at with VeriSign and Yelp and also Baidu potentially. But you get other opportunities. These are our momentum breakouts. Stock goes above the upper volatility band. Now, usually you get a pullback. You don't want to chase it. So of the 5 signals here, 4 out of the 5, you got a pullback. You just saw one recently. Now, the ready aim fire signal came here in February when the stock had a neutral rating. So I'm looking for everything to line up. John might have jumped on that in Micron. Tech is big. Look at this stock. It's gone from 45 to 62 today before it reversed a bit. And that momentum buy signal told you that the stock had broken the upper volatility band. These are Keltner channels. You buy the pullback. So tech is still good, very overextended. Major banks. Who benefits from rising interest rates? The major banks. Why? Because there's something called net interest margin, difference between what they borrow and what they lend at. And when rates are going up, net interest margin increases, and you want to own stocks like JP Morgan, the regional banks like SunTrust, Fifth Third Bank Corp, key banks. But the key is to buy on weakness. You don't want to pay up in a volatile market, and volatility is back big time. So again, February 6th, pull back to 104, 106. If you believe in the methodology, you look for a signal. John's got these great compression signals. Buy the stock. And that's pretty much what I have to say, John. I think that people who come to Austin or dial in via your webcast are really going to have a ball, because you and I are going to have a ball. So thank you for allowing me this 15 minutes to show what Chaikin can do. And why don't you take it over and sort of wow them with what you got left?
Sure. No, thanks, Mark. That sounds good. So I'll go through a couple of slides here real quick with you guys, and you can just kind of see. So we're going to be doing a live event, which the live event is actually almost filled up, but we're opening it up to online as well. And can you guys see the slide? It just says the 2018 Spring Austin Mentorship. I just got a couple of slides that's going to show you what's there. If it's something that kind of, if it interests you, there's a lot of okay, great. There's a lot of cool things there. So here's what we're going to be covering there. Now, Mark and I are going to also have a great discussion. So we just kind of broke everything out. But you can see we're going to have a global market macro discussion with myself and Mark. And that's going to be great. We're going to be doing that. I believe it's on Sunday. Also, we're going to be talking about the crash-proof trader strategy. Okay, it's just kind of an in-depth discussion on kind of the specific technical things, whether it's through something like a Brexit or a flash crash, or just normal market conditions. Just, how do you structure your trading so that, if you wake up and there's some crazy stuff going on, it's not a huge deal, that kind of stuff. And then we're also going to have live trading sessions. And the live trading is great because it's one thing to sit there and look at something and say, oh, okay, well, if this happens, I'm going to enter. Versus when it's really happening and there's money on the line and you can kind of see what's going on. So live trading like that can be, it's very fantastic from that perspective. Also, we're going to have a session on cryptocurrencies. Okay, what's next for Bitcoin? everything talking about all the different events happening in that space, cryptocurrencies, blockchain, et cetera, et cetera. We have, I always call it Jim Cramer's favorite Fibonacci analyst, Carolyn Boroden, Fibonacci Queen. She's hilarious. She's been doing this for a long time, and she's going to come in and just do like, hey, this is Fibonacci timing and price. And again, it's all stuff that actually works very well in conjunction with Marc software as well. Also, there's going to be some talk on futures. I think that's very interesting too, especially with what we're talking about with interest rates. A lot of people don't realize that the interest rate market, i.e. bonds, is the most liquid market on the planet. So there's I think a lot of interesting trading opportunities that are going to take shape there. From there, we're going to have our resident Elliott wave expert, David Starr, who just a vast amount of knowledge in some of the tools that he's created. We're going to be talking about how to trade options for income. So if you're just looking like, okay, I need to crank out $5,000 a month or whatever it is, how do you do that with options? And then we're also bringing in a sports coach. He works with professional athletes to talk about mental trading toughness. All right, and I'm really looking forward to that because that's actually a part of the game that you need to have as well. So just to kind of give you an idea from a live perspective, what this looks like. We try to keep the live event pretty manageable, meaning that, I think it's after something like 75 people, we cut it off. From there, though, that we allow online access. But the idea there is, we get to hang out, we get to talk. You'll see there's one night we have a Texas Hold'em tournament. I think this is great because it teaches amazing money management skills, okay? And if you've never played, it's just a great thing to understand. I always say, like, if you have a crappy hand in Texas Hold'em, you don't have to bet big. You can put in a small bet. Okay, I want to put in $1 here to see if I can at least get a good hand. And I kind of equate that to taking a pilot position. It's like, okay, yeah, I might buy 1,000 shares of Micron here, but you know what? I'm going to start off with 50 shares and see how it acts over the next couple of days, right? And it's a really good way to kind of build up a money management technique. From there, we do where we're going to be doing this live is set up for traders. It's got good internet, stadium seating, and we'll be live streaming this with cameras so you can see from the comfort of your own home what everybody's doing and stuff like that too, which is fantastic. So anyway, it's a good group. You kind of make lifelong friends. Even if you're just doing it online, people can still chat with each other online and stuff like that too. So, so why do something like this? Why do mentoring? And really what took me to the next level in trading were my mentors. And with mentors, I learned insights I didn't know, okay? When in a mentoring type of situation, essentially we're passed along information and perspectives that we need to hear. We may not want to hear them, but we need to hear them. Well, that's where you get them. It's a safe space, right? Blind spots I couldn't see. With an objective group, attitudes and behaviors can be pointed out in a safe setting, right? Which, if I had left them uncorrected, could cause enormous harm. Strengths I hadn't developed. Positive feedback from other traders can breathe life into our own motivation. Sometimes trading can be tough on us, right? Disciplines I couldn't build on my own. We don't know what we don't know. Let others who have been there before show us the way. And finally, just potential I may not have understood. Mentors see potential that we can't see in ourselves. So what I like about kind of a 3-day event like this is that you're going to get to check out of your own life and really focus on something that you're interested in. And when you're doing something like that in a compressed time frame, like 3 days, again, whether you're online or live, what happens is you just kind of put everything else in your life on hold. And because of that, you end up getting stronger insights than you would, overdoing it piecemeal for a year. So a lot of times, what happens is people come to these events or participate online, and it really changes their trading for the better. So here's the link, here's our phone number. So if you're interested in this, and we'd love to have you attend. Again, the in-person event is almost sold out. So if you are interested in that, you can call us, all right, and just kind of see what's going on there. But it's we've opened up the live stream. So from the comfort of your own home, you don't have to travel, you don't have to pay for hotel expense. The live stream is just $14.97. And again, you get access to all 3 days. If you can't, if there's some parts of it you can't attend, you'll get recording. There's online materials that we're going to hand out, but it's really just a good overall package to really take this trading to the next level. And I think it's going to be critical. We've had I do think that, we've got an economy that's heating up. We've got volatility that's heating up. There's some big potential changes on the horizon. And for those of us that are prepared for that and we understand what to do and how to take advantage of it, it's going to be a great couple of years. For those that don't, if they're, believing the doom and gloomers and doing all that kind of stuff, it's going to be a disaster. And so it's something like this to kind of get your head on straight and get everything going. So anyway, again, you can just type in simplertrading.com/SPX. It'll take you to that page. If you have any questions, you can call us here. Otherwise, thank you so much for joining us, Mark. As always, it's always a pleasure just kind of sharing the online stage with you and comparing notes. And I always learn something every time I hear you.
John, there's only one thing missing from this conversation.
What's that? Oh yeah, we got to get some barbecue.
Where's the Texas barbecue?
We'll have to hook up the barbecue. We'll get that info sent out.
It's been great. Thanks for the opportunity. I love it. I'm looking forward to Austin.
Good deal. Yeah, we'll see you in a couple of weeks. All right, guys. Well, thanks for joining us. Hopefully, got some use out of that. You have a fantastic evening, and we will looking forward to seeing you in Austin. For those of you that are coming, join us online, and of course, anything else that you'll be doing in the future with either one of us. Have a fantastic evening.